All right, Chapter 5, Accounting for Merchandising Operations. There are a variety of different types of companies, and we'll look at a couple of the more basic forms. And the first one is the service companies. And service organizations sell time to earn revenue. An example would be like accounting firms, law firms, and plumbing services. And then you have, for the company, you have revenues, and you minus expenses equals net income, the basic income component of the income statement. Merchandising companies, there are a variety of companies here. And so you have manufacturing that makes a product who usually sell to a wholesaler. And wholesalers are organizations that might cover a large region like the Northwest United States or the Southwest. And they in turn service retailers, stores, who then sell to the consumers. And so these two organizations are known as merchandising companies. They do not manufacture products, they simply sell products made by other manufacturers. For reporting income for a merchandising company that sells products and earns revenue, we have to go through a different kind of a step than the simple income statement equation. Here we have net sales minus cost of goods sold, and we will have to track that, equals gross profit minus expenses net income. So you can see this is a multi-step situation here. And here it is on a vertical basis. Again, net sales, cost of goods sold equals gross profit, and then your net income after you subtract out the expenses. So this is a more elaborate equation here. The operating cycle for a company, they typically have to buy inventory, and then that inventory is delivered, and then they stock their shelves and they sell the inventory. And often they'll have to take accounts receivable, and then they collect on the accounts receivable to get cash. And this operating cycle for cash has to be planned for very carefully by the chief financial officer or the owner of the company, because this can take up quite a bit of time that they have to finance out of their operations, and this can eat up quite a bit of cash. Inventory systems we're going to get into for how do you track inventory. And you start with beginning inventory, and then you add your purchases throughout maybe that period, whether it be the month, quarter, or year. And this equals the merchandise available for sale. And then you obviously sell your cost of goods sold, and then you have your ending inventory. There are two types of inventory systems used by merchandisers, both wholesalers as well as the retailer. And the perpetual system continually updates accounting records, and this is becoming the most predominant system because of the computer technology through barcode scanning and so forth. Some companies still use the periodic system, and that's where they only update at the end of some accounting period, and they'll actually go out and have to go count their inventory. Again, the perpetual system, this barcode has changed the industry. They can quickly monitor their inventory as well as their accounting systems and sales and so forth. And so this has been a great asset for merchandising companies because it has simplified and lowered the cost of maintaining their systems. So let's look at what happens here from an accounting standpoint. And it starts with, well, you have to buy your inventory. And here they're using cash. They could also do it on accounts payable, but here they're taking up cash. And so you take out the cash, and now you debit your merchandise inventory. Trade discounts. Often manufacturers and wholesalers will offer better prices for greater quantities purchased, and this is also true in the retailing establishment. Again, your larger customers tend to get preferential pricing, and I mean, this is the basis of Walmart right here. They get some significant volume discounts because they are the largest retailer. And so often the companies will offer this trade discount and we have to calculate it. And for instance here they're getting less 30% discount. You can see that'd be quite a bit of profit or better pricing advantage here for companies. And typically this will be an invoice when you order your product, and you'll notice the name of the company, the invoice number, and then the purchase order date. And then we get into the terms, and you see here they have 210 net 30. We'll go into that in a minute. We'll also get into what this means, freight on board, destination point, and then they list the various items and so forth. So there are some key points here we have to look at, both the date, the invoice number, and especially the terms and freight, because this will have some impact here. Purchase discounts. Again, there's a credit period and a discount period. And the discount period can also affect not only the volume, but at the speed of payment. A lot of times they want to incentivize the retailer or the wholesaler to pay promptly. So let's get into how you calculate this. So you'll see terms like 210 and 30. Could be 615 and 60. These will vary. And so what you're looking at is the discount percent if you pay within 10 days. Again, they're giving you an incentive to pay. If you pay within 10 days, you can take an additional 2% off your purchase price. Otherwise, if you don't pay within 10 days, the net amount is due within 30 days. They're still extending you credit for 30 days, but they're giving you an incentive to pay within 10. They want their money, and they'll reward you for that. So how you do this is you purchase your inventory just like you did before, but you don't take the credit discount, but you note it in the explanation tab here. And then when you go to pay it, obviously there's merchandise inventory, and you're taking the 2% discount right here, and then you knock down what you're paying in cash. So you're still knocking down the whole $1,200 on your accounts payable, but you're only paying this amount, but you have to keep track of this discount. Otherwise, this will not be in balance. And here's what it looks like when you post your accounts. Merchandise inventory, accounts payable. And then you would also want to track down your discount component. Purchase returns and allowances. Sometimes you buy a product just like a customer in a retail store, and maybe they sent you the wrong product, or maybe they sent you too much, or you don't like the product, the size, color. There could be a variety of reasons here. Or it could simply be defective merchandise. And so you can return that for a credit back. So what happens here is they have their accounts payable, but they send back the inventory, and so they take away the inventory, hence it's a reduction, a credit, and then they take away from their accounts payable. They're reducing it here. And they'll allowance, again, make the note here. It's important to keep track of these notes, or to give you enough information, because when you go back to audit or follow a transaction, this can be very informative. Again, here they purchased $1,000 worth of merchandise on June 1 with terms. 2 days later they return it because of whatever reason, and then later they take the 2% discount only on the $900 remaining balance. So let's look at this. Here's your purchase. You notice they make a note here. They return $100. So they're reducing the inventory as well as reducing the accounts payable. And then they're paying it, the $900 remaining balance, with an $18 credit, and then the $882. And then you make that note. Transportation costs and ownership transfer. This is actually a little confusing at first, but is used extensively. So when we had that earlier term, freight on board, There are two ways this can happen. We have FOB shipping point and FOB destination. And what happens is the seller, i.e. maybe the manufacturer or the wholesaler, has their inventory and they put it on the truck. And then they ship it to the buyer, maybe the retail store. Who owns this product? We know the seller owns it here, but once it goes on to here, who owns that? And who owns title to that property, excuse me, as well as maybe the insurance risk for making sure that that is insured in case there's an accident on the road. Again, FOB shipping point says the carrier, here's on the carrier, and the buyer of that merchandise owns it as soon as it leaves this dock and it's put on the truck. Whereas if it's FOB destination, then the seller owns it until it is delivered. Huge difference here, and this is negotiated between the buyer and the seller. Need to study the slide. It is going to be on the test. Transportation costs, FOB, who also pays for the shipping costs, can be another issue for discussion here, and or negotiation between the buyer and the seller. If the buyer is paying for the shipping, you actually add that shipping cost to the cost of your inventory. You add it to the cost of your inventory. Whereas the seller would actually keep track of it, and it's not on the cost of their inventory, it's simply another expense item as shipping. Again, here's how you keep track of it. You purchase your inventory, you take your discount, maybe you've returned some product, and now you add your transportation costs in. Notice transportation in, and this is what you keep on your inventory balance. It's a little confusing because the seller tracks it differently. I'm going to stop here. We'll continue this slide on part 2. Thank you.